Okay, there we go. Sorry. I have been, everything's running a little bit slow on my end, so I'm not sure what that's about. If you know how to get into the conversation portion of the meeting, please, if you would, go in there and just let me know for sure that you can hear me. Just type, yes, if you can hear me okay. Hopefully that's the case. My Every time I try to admit someone, it's kind of stalling out. So right now my camera's frozen. And okay, great. Thank you for letting me know that you can hear me. I've got a couple of pop-ups taking place here asking me to admit some people into the meeting, some of which seem that they're already here. So I'm not sure why it keeps asking me to do that. But okay, so I've probably spoken with you on the phone, text message, email, something like that. I am Brian. I am the general manager, and I'm acting as the tax school liaison for Jackson Hewitt in Michigan this year, and probably for years to come, hopefully. So I am. I did the same presentation on Wednesday. So if you happen to see that one, then this is going to be the same exact thing. Okay. This I'm trying. I'm knocking the rust off, so to speak, and getting back in the swing of things in doing these presentations. So I apologize if we run a little long. I'm trying to work on my timing and still cover the content sufficiently. So real quickly, this is a live session. I'm basically going to go through the uh, slide deck that's going to present everything in sections 1 and section 2 from tax school. You can certainly do this on your own as part of the self-paced program. You do not have to participate in the live events. However, we feel that it gives an opportunity for people to see someone, such as myself in real life and know that, we're real people. We're here to help. I'm here to help and kind of just help you through some of this and make you feel more comfortable to reach out if you feel like it. But I will continue to do these for the rest of the sessions going forward. If you have any questions, concerns, comments during this, or once we complete this session, don't hesitate to reach out. Um, I've got numerous ways you can get in touch with me, and I'll always happy to hear from you. Okay, so we are going to jump right into this is filing information and requirements. This is the first section in tax school. After I think there's an intro section, but this is the first like real session of tax topics. The one thing that I do want to point out on this is that much of what much of everything in tax school is actually handled quite a bit by our software called Profiler. And so a lot of these things I'll reference time to time that you're not actually going to see it this way, or you don't have to necessarily remember these things um, to prepare taxes. Okay, because the software walks you down a great path of very simple questions, makes it easy for you to determine like someone's filing status. Okay, as an example. But I'll jump right in here so we can get through this fairly quickly. I hope to be done by about 7:30 tonight. So, all right, filing information requirements. So the main question when it comes to filing requirements is who has to file, and the the answer to that is it depends. So there are several factors that come into play when you try to determine whether somebody has to file. However, there are people that don't have to file. They're not legally obligated to file. However, it's beneficial for them to file. Okay, so there's kind of two different categories: people that are legally required to file, and people who would benefit financially from filing. Okay, so these what's listed here are some of the considerations that you start with, and age comes into play for people that are 65 or older. They have special uh, additional standard deduction items, as well as people who are blind. They also have additional. Um, but the next thing is we'll go through the after age. It basically comes down to income. Okay, so um, we've got several different factors that come into play for determining whether someone has to file or should file. And it comes down to five different filing categories. We got most taxpayers, which are like, probably 90% of the taxpayers out there fall into most taxpayers. Dependent taxpayers are when a dependent actually has to file a return, okay, which happens sometimes. Then we've got children, uh, self-employed individuals, and then aliens, which would be a less than favorable term in these days, but it would be basically anyone who is not a U.S. citizen or yeah, has not gained their citizenship yet. So age requirements. So when you determine someone's tax age, you take the tax year. So this coming tax year will be 2021, even though it'll be 2022. And then you subtract the person's year of birth, and that'll give you their tax age. Okay. So the one caveat to that is that anybody born on January 1, they basically get a year added to their age, to their tax age. Okay. So Julie was born December 2nd, 1978. If you take 2021 and subtract 1978, she's 43 years old for tax purposes. Okay. Now, Dennis, he turned 65 on January, or is going to turn 65 on January 1, 2022. His birthday is right around the corner here. He will be considered 65 because his birthday falls on January 1. This only applies to people that are born on January 1, which we all know is, a fairly small number. Um, 1/600 or 365th of the population, I suppose, something like that. And it really only has an impact on your 65th birthday because otherwise it doesn't really matter. So then what you need to look at next are gross income. Okay. And so one thing that you guys will definitely run into when you are doing tax returns, you will talk to people that are self-employed, whether they give themselves that title or not. Okay. So something that you do run across fairly often actually are people who are actually self-employed, but they call it something else. They say they're being paid under the table, or do they have side jobs that they don't really report? Well, none of that falls. All of it's required legally by the IRS to be reported. There's no, you know, income that's not reportable, uh, and the threshold for filing as a self-employed individual is actually incredibly low. If you if a person earns $400 of their net income during a year doing self-employed work, they are required to file a tax return. So, I mean, that can fall. You can work a couple of weeks or a week in the construction industry as a contract employee, get a 1099, and have to file that, even if you don't get a 1099. Actually, the 1099 is required at $600. So there are a lot of people that do these quote unquote side gigs that they need to be reporting, and that's one thing that you'll run into often. Then we've got another category is unearned income, which has different filing thresholds than earned income, which is interest and unemployment compensation. Obviously, unemployment compensation was a big one last year, and it'll be a big one this coming year as well. Okay, so then this is the table that shows you where a where someone falls. If they're single, under 65 or over 65, then these are their thresholds. Okay, so if they're under 65, it's 12,400, which is the same as the standard deduction for a single individual, and then same is true for 65 and older. Then you've got married filing jointly, same situation, and it just kind of goes through a breakdown of those things. That's called Chart A, and there are some things that we'll refer to Chart A in a little while. One thing that I do want to point out while we're here is that married filing separately, that's a filing status that we discourage if really, really if possible. I mean, if it's not a favorable filing status at all, in fact, here it shows that $5 is the threshold. So if you're married or if taxpayer's married and their spouse does, and they file married filing separately, and one spouse makes all the income, the other spouse makes maybe a tiny bit of income. So $5 is the threshold for that one. Okay, so they both would have to file if the spouse that isn't making very much even brought in $5. Okay, so this is a quick example. Tommy and Sandy are married and live together all year. Filing status is married filing jointly. If you add those two amounts up, the 10,250 and the 14,773, they exceed the $24,800, so they are required to file. All right, so then this one is a married filing separate example, and this shows that Tommy and Jen are married. Jen earns most of the income, but Tommy did have a little bit of income. And so because it's $37 and they're filing married filing jointly, separately, they're both required to file a tax return. Last time I did this one, these knowledge checks, I think really kind of slowed me down quite a bit. So if you guys would, take a look at the knowledge checks on your own. Um, they are in the slides that I included in the PDFs when I sent out the invitation, and they actually have the answers in there too. So take a look at those. I just don't want to keep you guys too terribly long. So to with a married filing jointly or single or anything like that, the profiler married filing separately doesn't work very well because you know I mean, you can do it, but there's nothing to tell you within Profiler that the other spouse necessarily has to file. Is why I'm saying it doesn't work very well. We can definitely we do lots of married filing separately tax returns, but that's one thing that it won't catch because you don't input the income of the other individual uh, for married filing separately. But most of these things, you put in a person's name, date of birth, um, and start putting their income information, it'll actually tell you whether they need to file or they don't need to file. And then most of the time, it's going to be beneficial for them to file, even if they're not legally obligated to do so. Okay. So this talks about dependent taxpayers. Okay. And whether dependent taxpayers need to file out their own tax return. And that comes, there's several factors that determine that: marital status, age, blindness, unearned income, earned income, and gross income. Okay. So then this chart B, you can go through and check these boxes, say yes, no to different categories, and it'll let you know whether they need to file their own return or not. And actually, when you do this, and we ran into this a bit last year, that we would do tax returns for parents whose children were getting substantial amounts of unemployment, where they would actually have to, they're required to include their kids' income on their income and be taxed on all of it, just because of how some of the rules played out. But that's kind of a side note. But so this will let you know who needs to file as far as dependents go. All right, so this one talks about Natasha. She's being claimed as a dependent, and it asks whether she needs to file or not. Let's see her. Uh, she's not blind. Her under income is $412 in dividends. She's 16 years old. her earned income is $10,518. Her gross income is the combination of those two things. She does not need to file because her um, unearned income and her earned income fall below the thresholds that are noted on the right hand side right over here. Okay. Then we got self-employed individuals. The biggest thing here is that $400 threshold. People, I don't care if they're selling firewood. I mean, if you're making $400 or more, you have to file a tax return legally. I mean, you people choose not to, and um, they're out of compliance, but that's what they choose to do, and the IRS will, it'll eventually catch up with them one way or another. One way that it caught up with a lot of people this year is the stimulus. People filed tax returns for the first time in, like, 10 years because they've been working for themselves. They haven't been filing taxes, but they wanted the stimulus. So then they filed the tax return. The IRS said, well, we'd really like to see the last 10 years of your income because you haven't been filing your tax returns. So, one other thing to mention here that you see uh, fairly, I mean, not even fairly, you won't see very often is church employees that have income of $108.28. Don't have any idea where they came up with that number, but some church employees are considered self-employed. Pastors, for instance, you will run across them every once in a while, and they're considered self-employed individuals. It's kind of a weird portion of the tax code. Okay, resident aliens generally follow the same rules as U.S. citizens, so there's not much difference there. The only one difference is whether they can get a social security number or not. So this is chart C. This covers anybody who there are other situations. Okay, so uh, what causes people that are not in the traditional groups to have to file? One is the self-employment of at least $400. Talks about the church employees here. One thing that we've been seeing more and more of are people that get health savings account distributions. So, people set aside pre-tax money and use it for medical expenses. Anytime a distribution is made from one of those accounts, you're required to file a tax return, um, just as part of the tax code, even if you didn't have any income that year. They want to make sure basically that you spent the distribution on medical expenses. Okay, so this talks about even when taxpayers not required to file, they should file because of certain reasons. And one of the reasons is if they have income tax withholdings that they could, get back. Anybody who falls under that $12,400 threshold for a single person or 24,800 for a married couple, uh, they'll get all their withholdings back because they have $0 in taxable income. However, even if they don't have withholdings and they make less than those amounts, they may want to file a tax return because there's substantial credits out there for people. This year is going to be huge in terms of something called the additional child tax credit. You guys have probably been seeing this on the news that people are going to be getting thousands of dollars in tax credit, um, even if they don't earn any income as a portion of the child tax credit. Okay, we're talking up to, I think, $3,600 is the maximum, and it depends on the child's age, but $3,600 in refundable tax credit, even if you didn't have a job, didn't have any income coming in. So that's going to have a positive impact on a lot of people this year as far as them getting a refund when doing their taxes. All right, so then it goes into another knowledge check, asking if Marshall needs to file or not. And I'm just going to kind of skip over these to make sure that we are staying on schedule. All right, so I'm going to repeat myself several times as these pop up over the next, several slides, probably, and I apologize in advance. But this is the personal information section. This is the top section of the tax return. It shows you this in tax school, but you actually don't see it in our software profiler because you just put in this information in a different format, and then the software plugs it in on the 1040, and you never really even see the 1040 until the return is done. Okay, so it'll tell you like where to put things in and that kind of thing, but it doesn't actually impact us when we're doing the tax returns. Although it's something that you need to learn in tax school, just because it's kind of like an extended aptitude test. We're just making sure that everyone, you know, has what it takes to get through tax school, and then we know within pretty good certainty that you're going to make a quality tax preparer. Okay, so this one's asking about Donald's age on the tax return. So we got a knowledge check right off the bat, which I'm going to skip over. And frozen up here. Okay, there we go. Oh no. All right, so PowerPoint just crashed, so I'm gonna have to reopen that. And what's going to talk about now are filing statuses, and how you determine a filing status. Um, you know, people that are single unless they have a child that they're claiming is a dependent. Doesn't have to be their biological child, but if they're claiming a child as a dependent, then they may qualify for something called head of household. Head of household would also require them to be a sorry, I'm trying to open this back up while talking to you without talking points. So the head of household requires not only for a a taxpayer to have a dependent, but it also requires that they pay more than 50% of the upkeep of their home. Okay, so the there. Hopefully, you guys can see that back. Um, this goes over the 5 filing statuses that are available. We got married filing jointly, married filing separately, head of household, qualified widower, and single. And these are all pretty straightforward. Okay, this again shows the filing status where you find it on the tax return, but that doesn't matter to us in Profiler. That'll fill it out for us. The first step in determining a taxpayer filing status is to find out their marital status on the last day of the year. So on December 31st, were you married? Yes or no? And that pretty much, uh, that includes civil unions, registered domestic partnerships. It kind of depends on state laws, but I mean it could be the same thing for common law marriages, which we don't have in Michigan. But let's say the couple became common law married in another state and then moved to Michigan, then it would be still common law marriage in Michigan. Okay, so marital status plays the biggest role. And if you're married on the last day of the year, then you're considered married for the tax year. If you're not married on the last day of the year, then you're not considered married. So if your divorce is finalized on December 31st, then you could be considered single for that tax year. All right, single people have either never been married or they're divorced. Their marriage has been annulled, legally separated from their spouse, which doesn't exist in Michigan, and or became widowed in a year prior to um, in a prior tax year and they've not been remarried. So if if your spouse does die during the tax year, you still can file as married filing jointly uh, because of they're still legally married during the year, and so that's kind of a difference between the being divorced on the last day, then you're considered single, versus losing your spouse throughout the year, you can still be considered married. All right, married filing jointly. This is an option for married taxpayers. They can combine their income and their deductions on one return, and this is a beneficial filing status for married individuals. It shows how the married filing jointly return is filled out at the top. And then we've got married filing separately, which is anybody who's legally married that's not filing with their legal spouse is required to file married filing separately, unless there's a small percentage of the population that can file as head of household, even if they are legally married. And we'll get into that in a minute. But even if you haven't seen your spouse in 15 years, you have no idea where they are, or but if your marriage is still legally binding, then you're still married. You can't file as single, even if you haven't seen them in 2 decades. Unfortunately, it doesn't matter to the IRS. The one thing where we will look at this portion of the 1040 is that this shows that when you're filing legal, excuse me, when you're filing married filing separately, you do have to list your spouse's name and their social security number on the tax return, which causes a problem for some taxpayers because they don't know that information. They don't know their spouse's social security number because they haven't seen them in however long. So that just means that we cannot electronically file it. We can file it on paper without that information, but hopefully you guys won't run into that issue. Okay. So this is an example of that. Okay. On this knowledge check that if they're married, they can file either married filing jointly or married filing separately. They can't file, single, for instance, even if they haven't been together. So, and this is one about someone whose spouse died during the year they can still file as married. All right. So, head of household. This is the one where even if someone is legally married, this is one place where they could switch and have beneficial status and not do married filing separately. So this is if the taxpayer did not live with their spouse at all in the last 6 months of the year, and they have a dependent. Those are, and they maintain the home, I guess, too. So they can fall under head of household if they meet those exceptions. Otherwise, head of household requires you maintain a home, have a qualifying child or qualifying dependent, and you're unmarried or considered unmarried. Considered unmarried is the part where you don't live with your spouse for the last 6 months of the year, then you can file head of household. So there is one important thing to keep in mind is that there are only one head of household allowed per the tax code per address. So if you have two tax families living under the same roof and you've got an unmarried couple and they each have their own kid or kids, and that they're claiming, only one of them can be a head of household, otherwise they'll cause problems with the IRS and somebody will be disallowed that designation of head of household. The benefit of head of household is it gives you standard deduction that is higher than a single taxpayer filing status. So this talks about, oh, sorry, I didn't mention this. So this is a worksheet on determining if you're paying 50%, over 50% of keeping up the main home for the family. And so pretty straightforward, Um, a lot of people, they say, I ask them that question, are you paying more than 50% of what it takes to upkeep your home? And they're like, I'm the only one paying anything to upkeep my home. So a lot of those are pretty clear cut. So single taxpayers that are filing as head of household, in addition to maintaining their home, they also have to live with a qualifying dependent or child or dependent for more than half the year. And the only exception to this is parents. So a taxpayer can claim their parent as a dependent if your parent is living in an assisted living facility, for instance, and but you are contributing more than 50% of their financial support, you can claim them as a dependent even though they're not living in your home. Okay. And temporary absences don't uh, have any impact on that. Parents, there's no reason or no requirement for them to live in the home, but children, they have to live in the home for more than half the year. With the only exception is temporary absences like vacation, illness, education. So that for like college students, that type of thing. Okay. So this talks about who who are the dependents. Okay, you've got qualifying individuals um, that you can claim as a dependent that's not actually your child. So it can be basically anybody that's related to you by blood or marriage. Pretty much falls into this category. Though the qualifying event is that the taxpayer is paying more than 50% of their overall, financial picture. Okay. So then we've got married taxpayers filing head of household, which is the one where I said that you can't live with your spouse during the last 6 months of the year in any fashion. If they stay one night in October, that eliminates the taxpayer from being able to use that status. Okay. So there, you know, there are no like wink, wink. He didn't live in the home. That kind of stuff doesn't work. Uh, it's if the IRS starts asking questions and that stuff comes out, then it's going to be an issue. All right. So, married taxpayers filing head of household, they must meet each of the following requirements, and it just basically says that they paid more than 50% of maintaining the home. They lived apart from their spouse during the entire last 6 months of the tax year, and had a dependent living with them for more than half the year. All right, so then this talks about what 1040 looks like for filing in such a way. Okay. All right, so head of household due diligence. This is something we need to ask questions of the taxpayers to make sure that everything is consistent, everything is accurate, and it makes sense. Okay, so you will talk to some people who are, I don't want to say evasive, but they don't feel like it's necessarily your um, right to know some things about their living situations, and so we do have to ask questions to make sure that you know, um, can we can reasonably assess the marriage status, living arrangements, relationship dependence, the cost of keeping up the household. Okay, we do run into uh, if the IRS were asked questions and we didn't ask and make sure these things took place, then we could face penalties. However, all you do is ask the questions and make good notes inside the software, and it takes care of everything for us. Okay, so this just shows this is Form 8867. It's the due diligence checklist, and one of the things that we check off, and we don't actually do it, but it happens in the software. Check off and we sign that we determined uh, that they're legitimately claiming the head of household status. Okay, qualifying widower is something that you won't run across very often. To be a qualifying widow or widower, it has to be a taxpayer who not only lost their spouse but also has a dependent. And for the tax year where one of the two spouses dies, the taxpayer can still file married filing jointly. In the two subsequent years, they can qualify as a qualifying widow or qualifying widower, which allows them to have the same standard deductions as the married filing jointly status um, for 2 years as long as they remain unmarried. Okay, but they do have to have a dependent. So my father-in-law fell into this category when my mother-in-law passed. My brother-in-law, I know there's a lot of in-laws in that that sentence, but when my brother-in-law was very quite young, he was a freshman in high school when his mom passed away, and so my father-in-law filed as qualifying widower um, for the 2 years after Carol passed. Okay, so single is pretty straightforward, right? If you're not married, never been married, or you are legally divorced, then you're a single individual. Okay, and single individuals can have dependents or they may not have dependents. So let's go back to the scenario where you've got a unmarried couple who each has dependents living under one roof. One can file head of household. The other one has to file single with a dependent. So the only difference is they lose out on a little bit of standard deduction. Um, but generally speaking, let's see. In if you're in the 10% tax bracket, we're only talking about like a $600 tax uh, implication, you know, that takes place if you switch those two statuses. It's not that big of a deal. So for the knowledge checks, okay, just comparison of the filing statuses. Uh, people may Taxpayers may qualify for more than one of the filing statuses. We have to determine which one is most beneficial for them to use on their tax return. Okay, so you've got your single taxpayers and your married taxpayers, and it shows which statuses that they can fall into there. Okay, so I'm sorry to rush through this, guys. I don't know if it's any better, but I've got a video of the other uh, presentation that I did that I guess I'll post both of them. Uh, but I struggled with time on that one too, and I'm sorry that we are running a little bit behind here. Okay, so here is I'm gonna jump into dependents now. So this is the second section of tax school, and talk about dependents. Okay, so we're basically wanting to determine who a taxpayer can claim as a dependent. Okay, and then how to report their information on the tax return. So a dependent has to meet both the following conditions. The taxpayer they must meet the general test for dependency, which we'll get into, and any potential dependents meet the test to be taxpayer's qualifying child or qualifying relative. Okay, there is something called uh, other dependent, which has just a tiny amount of tax benefit that can be used as well. One thing I want to point out here is that a spouse is never considered a taxpayer's dependent. You'll regularly hear someone say, well, I say regularly too loosely, maybe 10 times you'll hear someone say, well, I claim my husband as a dependent because he doesn't work and I'm the only one that brings home a paycheck, so he's dependent. Well, it's not exactly true. It's just married filing jointly, but you will hear it. But they're never listed as a dependent on the tax return. All right. So general tests for dependency include the dependent taxpayer test, the joint return test, and the citizen or resident test. Okay. And so this section right here, Table 5, goes over how to determine those things. It talks about things like your actual relationship. That child must be son, daughter, stepchild, foster child, brother, sister, half brother, half sister, stepbrother, stepsister, or descendant of any of them. So basically saying that if that includes like a niece, nephew, it's a pretty broad category. It also defines as a child as being under the age of 19 unless they are in college, then they're under the age of 24. Well, unless they're a full-time student, I should say, then it's under the age of 24. So when they say qualifying child in this instance, they are talking about not talking about like if you're a middle-aged person and you have grown children, they're still your children, but as far as tax purposes go, they're not your children. They're not a child. So then there are also requirements that the child lives with you for at least half of the year. The child does not provide more than half their own support, which is different from qualifying relative in terms of where the support comes from. Qualifying relative, the person claiming the qualifying relative actually has to provide more than 50% of the financial support for the individual, whereas a qualifying child just can't provide more than half of their own support. Okay, so first uh, the first example that comes to mind for that is like a child actor or something like that, something where the child has their own income and a significant amount of income probably. So the last qualification for that is the child must not be filing a joint return with anybody else. So if you've got a 22-year-old child that's in college, but they also happen to be married and they're filing a tax return with their spouse, you can't claim them as a dependent, as a qualifying child because they're married and filing their own tax return. Okay, so here's some knowledge checks. All right, this goes back to the same uh, table, and it talks about basically everything that I just covered as far as relationship, their age, the residency, supports, joint return test. One thing that I didn't talk about is a special test for a qualifying child of more than one person. Those are in situations where you've got a, uh, you know, possibly a divorced couple or a couple that was never married that have a child together that technically can claim, they both can claim the child. There are special rules called tiebreaker rules that the IRS uses to determine who can claim the child legally. Okay, so here's a list of those tests again, and then we've got some examples of those. Okay, so special rule for divorced or separated parents. This involves, custodial versus non-custodial parents. So the custodial parent can grant the non-custodial parent the right to uh, claim the child, even though they didn't live with them for more than half the year. Okay, and that is called a 8332. This is what the custodial parent will issue to the non-custodial parent to allow them to claim the child on the tax return. So these can be made out for multiple years at a time. Uh, if you were ever to advise a client on filling one of these out, you would recommend, or I would recommend them filling it out 1 year at a time. That way, it's only good for a year, and as long as everything keeps going the same way, it could be reissued year after year. However, it can be issued for, let's say, 10 years, right? But things change in that amount of time, and then they would have to revoke um, this claim. Okay, so here's an illustration of that. Just talking about revoking the claim, and this talks about these get pretty complicated, and since I'm not going to go through these, when you guys go through them, please, if you have any questions, reach out to me. Uh, Dependents are actually one of the more challenging things that you deal with, honestly, aside from maybe like self-employment and some some forms that you rarely have to deal with, like partnerships and that kind of stuff. But dependents can be fairly complicated. Our profiler, the software that we use, tends to do a pretty good job of narrowing down who's who. But when you're going through these things, don't hesitate to reach out to make sure you've got a good grasp on it. Okay. All right. So this is what I was referring to as the tiebreaker rules, where child qualifies to be claimed in more than one person. Uh, these can get these can be messy situations where two parents are trying to claim the same child, and um, what it comes down to is the tiebreaker rule. Okay, and there are multiple rules, and I don't know if it actually lists them here, but some of the examples are. Uh, this is basically probably just wanting you to know that there are tiebreaker rules. But for example, if two parents claim the same child, and one one of the tiebreaker rules is who makes more money, so that gives you the understanding of, basically their reasoning on that is if spouse A made more money than spouse B, or excuse me, parent A made more money than parent B, then parent A must have contributed more money to the financial, well-being of the child, I guess. So, but for the most part, it's just wanting you to know that those types of things do exist. All right, this one talks about qualifying relatives. So we're not talking about a qualifying child. It's we do have a member of household relationship test, gross income test, and support test. Okay, so on as I mentioned before, with qualifying child, the taxpayer does not have to contribute more than 50% of financial support. It's just that the child cannot provide more than 50% of their own support. Whereas qualifying relative, the taxpayer that wants to claim the qualifying relative, they must provide more than 50% of the financial support of that individual in order to be legally able to claim them. So this is an example of that. This one says basically that um, I will go over this one real quick because I think it's a pretty good example. Yuki's 21. She lives with her aunt Tanya, who's 50, who's claiming her as a qualifying child. Yuki's a full-time college student and receives 40% of her support from Tanya. Okay, so she's 21. So since she's a full-time college student, she can be a qualifying child. Okay, so that's the distinction here. So Tanya provides 40% of the financial support for Yuki, and that's okay in this situation because Yuki's a qualifying child. Now, if Yuki were not in school, Tanya would not be able to claim her, but she only provides 40% of the financial support, and you have to provide 50% of more than 50% of the financial support to qualify as a qualifying relative. Okay, so then that's what this talks about right here. Okay, that once Yuki's not a college student. So this goes back to um, rules for claiming a dependent. So it talks about all the rules for qualifying child versus qualifying relative, and basically, if you claim a qualifying relative and you provide more than 50% of their financial support, they must also have a gross income that's less than $4,300. Okay, so that's one thing to keep in mind. But they can't earn much money on their own. Otherwise, it doesn't work. So then this is a very detailed way of coming to that conclusion, whether you can claim them as a qualifying relative or not. Okay, and that's worksheet 3-1. All this stuff is done for us in Profiler, but it's just what tax school wants you to know for the purposes of just getting through tax school. Okay. All right, so this shows where the information is entered on 1040, which, as I mentioned earlier, we don't need to worry about it because Profiler does it for us automatically. However, in tax school, they might ask you some of these things during these knowledge checks or at the end of session assessments. Okay, so that actually brings us to the end, and I actually got through that more quickly than I thought I was going to. Skipping the knowledge checks has a huge impact on how quickly I can get through these. And it does talk about homework on these, and that is not necessarily something that you have to do. But when you guys go through this and you're getting back into tax school, I'm gonna just open up tax school real quick over here so you guys can see something really quickly if I can get it to open. So since you guys completed this live session with me, when you go to tax school, you should be able to jump down to the assessment. So when you just log in, go to session 1 and session 2, and you can skip all of the slides and just jump down to the assessment section, and you don't have to go through every single slide. Okay. So I'm just going to show you real quick how easy that is to do. And this is the same process that you want to take if you are if you're having a retake a section for any reason. this is the same type of process that we go through to be able to make that happen. And I apologize for everything running so slow here. I am going to pull up back to the comment section. So if you guys have any questions, you can go ahead and stick them into the conversation section here while we're waiting for this stuff to load up. And I'd be happy to answer any questions that you have. Otherwise, I'm going to stick my this is a direct text number or a direct phone call number. It's my work number, but it goes directly to my cell phone. So feel free to utilize that. I may have already talked to you guys on that, or you may have talked to me on a different number. I kind of use a few different ones, but that is probably the best way to get in touch with me. If you have any questions, I'd be glad to help there. So I am just getting into tax school real quick. Trying to. Here we go. Hopefully everybody that's on this call already has their tax login credentials information. That's another thing. If you don't have those for whatever reason, you should have received an email with them. But I'm happy to send them again if you're unable to locate that email. So, tax school, go to my classes, and then once I get into the fundamentals of tax preparation course, because I've got many courses on here, to open that up. And I'm just going to jump to a random session that I haven't attempted yet. So this is session 4, not attempted. For you guys, it'll be 1 or 2. But I'm just going to show you, since session 4 has not been attempted, I'm going to go ahead and open it, and then just show you that you do not have to go through each individual section or the lessons to be able to jump to the assessment. So I just go here and I click on assessment, and it automatically lets me start taking the test. Okay. So since you guys have done this, just feel free to go ahead and do that to get to get done with sessions 1 and 2. You definitely don't have to join me. It would take a lot longer to go through the number of weeks that it would take you to go through the same amount of material that you could probably get done in a day. If you just hit tax school, these live sessions are not required. Like I said earlier, it's just for some engagement to help you guys kind of get to know me and know that I'm here to help. I really truly am. I'm glad to help in any capacity that I'm needed. So please, guys, if you need anything from me, don't hesitate to reach out. I'm gonna go ahead and sign off here. If you have questions, concerns, need help with anything, please call me, please text me. I'd be thrilled to help you out. Okay. So thank you for joining me. Have a wonderful evening, and I hope to hear from you soon. Thanks, everyone. Bye.